Walker Blue, formerly known as Walker Reid Strategies, is a Boca Raton-based energy engineering and specialty tax consulting firm founded in 2010. They specialize in delivering federal energy-efficient building tax credit like Section 179D, 45L, and 48E through services such as energy modeling, measurement and verification, investment-grade audits, utility tax exemption studies, and technical or compliance support for ESCOs, architects, engineers, CPAs, and public sector clients. In 2025, they merged with Blue Energy Group and rebranded as Walker Blue LLC. B3 Benchmarking is a secure, cloud-based online subscription service that collects, stores, manages, and analyzes utility data for buildings. For owners aiming to leverage the alternative measurement pathway and maximize 179D tax deduction, B3 Benchmarking offers a comprehensive and streamlined solution. As a powerful energy analysis and tracking tool, B3 provides the data insights and reporting needed to both qualify for 179D deductions and simplify the compliance process. Whether you're managing a single facility or an entire portfolio, B3 benchmarking helps align your sustainability goal with real financial incentives. And with that, good afternoon, everyone. My name is Sim with the Energy Management Association, and I'd like to welcome you to today's webinar and thank Walker Blue and B3 Benchmarking for sponsoring today's session. A few items before we get started. Presenters will be holding the questions until the end of the presentation, but we encourage you to submit them at any time using the Q&A button. If you happen to be experiencing technical problems during the webinar, please use the chat function to inform the panelist, and our technical expert, William, will assist you. This presentation is being recorded and will be available for viewing in 1 week. In terms of the continuing education credit, everyone in attendance for the full webinar will receive a certificate of attendance sent to their email within 24 hours. And finally, if you are a certified CXA or EMP, your CUs for attending any webinar will be automatically uploaded to your respective portals. Today's webinar is Trends of Energy Tax Incentives for the Built Environment with David Diaz, the Chief Strategy Officer, and Weston Lustig, Director of Walker Blue. A little about our speakers before we get started. David Diaz is the Chief Strategy Officer at Walker Blue. He has over 20 years of experience in construction and real estate and is nationally recognized for his expertise in Section 179D and 45L tax incentives. He leads the company's energy tax incentives practice and oversees engineering efforts like energy modeling and verification, guiding clients through compliance and optimizing financial returns. Our other speaker for today is Weston Lustig, and he's the Director of Growth at Walker Blue. With a focus on marketing and business development, he helps share internal training and go-to-market strategies and frequently co-presents webinar on energy tax incentive trends along with David Diaz. So again, thank you everyone for joining, and speakers, you have the stage.
Great. Thank you, Sim. And I really appreciate everybody joining us here today. So as stated, I am Weston Lustig. I do head up our business development and growth efforts here at Walker Blue. Very exciting stuff. Before really jumping into it, I do want to address that we are recently, as stated, now Walker Blue. It's very exciting. So previously, David and myself are at Walker Reid Strategies, and we recently merged with a fantastic, friendly competitor in the space, Blue Energy Group, which is now formed Walker Blue. We are now one of the leading providers in, specialty tax incentives and energy engineering, and it's really vastly kind of grown our business and our capabilities. So if there's a little confusion about previous marketing materials or anything along those lines, rest assured it is Walker Blue now, previously Walker Reid Strategies. So without further ado, let's jump into things here. Let's just go over agenda or key points today. So we're going to be discussing, as stated, the Section 179D federal tax deduction. I'm going to talk a little bit about the overview of what it is, sort of some of the key legislative changes that have occurred in the past. We're going to discuss a little bit about labor requirements as they relate to some of the multipliers you're going to be able to take to maximize your tax deductions. We'll discuss the allocation of the Section 179D federal tax deduction, so how it can be allocated from tax-exempt entities to designers. We will then move into the one big beautiful bill, which is the most recent legislative change that has heavily impacted the tax incentive space as well as impacted Section 179D itself. We'll then talk a little bit about additional services here we offer at Walker Blue, and as discussed, we will then move into Q&A. So before I dive into what we define as legacy Section 179D and post-IRA Section 179D, right, I'm really just going to start kind of from the beginning for folks that may be a little unaware of what Section 179D is. So enacted as part of the Energy Policy Act of 2005, 179D was created to incentivize energy efficiency in commercial buildings. The US recognized that commercial buildings are responsible for roughly 40% of energy consumption, and the goal was to encourage an energy efficient design of new buildings as well as retrofits, right? So originally, it was up to $1.80 per square foot, focused heavily on lighting, HVAC, and building envelope. And it was only applicable to private owners and government buildings for allocation. Over the years, Section 179D has become a critical incentive for engineers, ESCOs, clearly building owners, and contractors to justify energy upgrades in both new construction and retrofit, right? An important key factor here as well is that in order to obtain this deduction, the IRS requires a third party, an independent third party, to conduct the certification activities in order to obtain the tax benefit. And that's how, Walker Blue and our peers in the space operate and kind of what our business is all about. So, like many, incentives in the tax space, Section 179D has never stayed static. There's always been sort of an ongoing change that is based on new legislation, right? And so that's what really brings us here to this slide we're looking at, which is looking at legacy or pre-2023 Section 179D versus post-IRA or post-2023 Section 179D. So we're going to kind of compare these, look at some of the key differences as it really informs where Section 179D sits today, how folks can benefit from it today, and kind of where it used to be. So starting on the left, right, just a few quick facts. As discussed, it used to only be up to $1.80 per square foot for qualified buildings, right? There was some additional inflation adjustment adders that might add a few cents on there, but that was roughly the total that you could achieve. There were partial categories, so you could get up to 60 cents per category: lighting, HVAC, building envelope. There were no labor-related requirements in the pre-2023 era that folks would take advantage of 179D. There was only government buildings from a tax-exempt perspective that would be able to qualify for allocating the deduction to contractors. There were whole building or partial categories that could be analyzed. And as stated before, that $1.80 was the total you could ever get per building. And I'll get into the difference in the post-IRA world and what that means in a moment. And then the interim lighting rule. So there was a simplified methodology for lighting categories that may have been used. with additional partial qualification opportunities. Now, moving into the post 2023 or post Inflation Reduction Act era, there were some major changes that occurred, most of which were highly beneficial for those taking advantage of Section 179D. The first being that it was now increased to up to $5 per square foot in addition to the inflation adjustments. So you could come somewhere close to $5.80 a square foot if those were accounted for. And then in addition to that, the partial, opportunity for partial deduction amounts per square foot were available, and they were based on energy qualifications and labor requirements now. Um, Labor requirements are a huge part of how you achieve the 5 times multiplier. So we're going to get into that in a moment. But the vast increase in per square foot availability on that deduction were based upon how contractors were paying and some of the apprenticeship requirements on each specific project. So again, we'll get into details later on that. There was an expansion of organizations on the tax exempt side that are able to allocate the deduction. So previously it was just those government buildings. And in the post-IRA world, that expanded to all tax exempt entities, which opened up, a door for a ton of different potential candidates that could take that deduction and allocate it to the contractors on that specific project. Uh, Another key difference here was that in the post-IRA world, there was a whole building analysis required. So there is no longer a use of partial system analysis for qualification. So a bit of a heavier lift there. Um, Another key difference that was really huge is you could recertify buildings for new energy improvements. So previously, there was a cap on the dollar amount per square foot. But in the post-IRA world, if new capital expenditure occurred in the private sector, that building could be recertified every 3 years. And in the tax exempt, it would be every 4 years. Additionally, there was qualification methodologies that got introduced. Retrofits may use EUI methodology, pre and post retrofit measurement and verification. So some additional methodologies there. So now that we've kind of discussed pre and post IRA Section 179D, we're going to move into a bit more, as we discussed earlier, about prevailing wage requirements and apprenticeship requirements, which is what need to be met to get that 5 times multiplier. So in essence, PWA basically means you are going to need to pay workers the Department of Labor prevailing wage. You are going to need to maintain apprentice to journey worker ratios, and you have to keep daily logs and certified payroll records, right? So I'll get into a little more detail, but just pausing here, this is a very large lift. If you think about how much effort it is going to take on a large scale project to be able to do this, right? To maintain these daily logs and certified payroll for, contractors, subcontractors, subcontractors to those subcontractors, it really becomes a tremendous lift. And it's something that a lot of businesses actually offer as like a standalone service outside of just obtaining, Section 179D or other federal incentives because of, the need to continually have to put resources on maintaining this. So that's actually something that not only Walker Blue does as an independent service, but many of our peers, just given sort of the complexity and ongoing effort. So moving into a little bit more detail about what PWA requirements really mean. Obviously, the payroll side must be certified, must meet the requirements set out from a state and federal level. When we discuss what apprenticeship requirements really mean, it kind of falls into 3 categories, and it's all based on placed into service date of the specific project we're referencing. So if a project is placed into service fiscal year 2022 and before January 29th of 2023, then it is exempt from the apprenticeship piece of the requirements. If you want to get the 5 times multiplier, you're still going to need to meet the prevailing wage piece. So you're going to have that daily log, certified payroll, and essentially audit ready, bookkeeping for that aspect of it to take the multiplier, but you do not need to meet an apprenticeship requirement. Now, for fiscal year 2023, you would need a 12.5% of total labor hours to be met and associated to apprentice that's certified. So that is a big piece of it that changes in fiscal year 23. Fiscal year 2024 and beyond, that's going to be up to 15% of total labor hours are going to need to be conducted by a certified apprentice. Now, additional few details on apprenticeship requirements. If a project has 4 or more workers, at least one is required to be an apprentice. As previously stated, the apprenticeship to journey worker ratio must be met on a daily basis, right? So it's really important to realize that it's an everyday kind of activity, and again, that is why that lift can be so heavy, and there's so much effort associated to maintaining, PWA records to obtain that 5 times multiplier on the deduction. Uh, it is important to note there's a good faith exception here. Um, and essentially, if the taxpayer requests qualified apprentice from the registered apprenticeship program, by usual and customary business practices for registered apprenticeship programs in a particular industry, um, and there's a continual effort to attempt to obtain apprentices, but essentially there is not enough apprentices to be able to meet the ratio and the hour requirement on that job. As long as there is evidence of a continual effort to put apprentices on the job and on that specific project, again, you must have that maintained kind of documented communication every 120 days. Then there is a good faith exception there where you're still going to be able to take that multiplier as long as you have communicated clearly that you have attempted to try to meet or exceed the requirements. So moving on, I'm going to go ahead and pass this over to David to kind of discuss with you guys the importance of pre-construction planning as it relates to prevailing wage and apprenticeship requirements for 1790. Over to you,
Yeah.
David.
Thanks, Weston. Just to touch a little bit before I get into the pre-construction planning, also on the apprenticeship good faith exemption. We've been kind of recommended, even though it is a pathway and a methodology to become exempt on these projects, we've been recommending against it when possible. When possible, the effort of going and either creating your own apprenticeship program if you have enough employees or whatnot, or between all the different trades on the job, being able to achieve that compliance effort, we feel is a much better, safer from an IRS audit perspective methodology. So just a little color on that. As far as pre-construction planning, so it's really important. If I drive at anything, it's that it's really important to kind of think about the 179D when projects are starting, whether it be a retrofit project or it be a new construction project. There's a lot of changes that are coming up. There's timelines and scheduling changes, which we'll get into later on when we talk about the big beautiful bill, that are accelerating deadlines for starting. So if you're planning on this as a tax strategy, it's important to kind of identify what those things are. And then on top of that, if you're planning on doing the prevailing wage and apprenticeship requirements to meet the 5 times multiplier and really maximize the incentive, it's super important that you get with a firm or somebody who can help you, like Walker Blue, and review what costs are related to the 179D, because it's there's a tax element to this. There's tax law behind all of this, even though it's an engineering-based study. You only need to meet the prevailing wage and apprenticeship requirements on the specific components, subcontractors, laborers that are involved in the process of qualifying for the energy efficient commercial building property, which is like your 179D property, as it relates to lighting, HVAC, building envelope. Lighting, HVAC, hot water, those are easy, right? It's your electrician, your plumber, your HVAC contractor. These are trades that this pretty simple. It's like it's that one or two folks who are involved, maybe the controls contractors that are involved in that. Where it gets a little tricky is with the envelope, because it's identifying which components of that envelope are going to play into into the energy calculations and energy modeling that we're going to do to perform to be able to certify these projects for the Section 179D. So again, having someone come on early, make those identifications, basically determine what's contractors, subcontractors, and which laborers, folks that are doing the work need to meet the prevailing wage, and then onboarding them on our software, getting that tracking done. That is a major component of the compliance piece. So really, really important to touch on that early. A lot of times there's design, if it's new construction, we can make suggestions from a design perspective. We can do some pre-construction modeling to achieve that and get you guys a good idea of, hey, where's this project now? Where's it going to be when it in a couple months when it hits, or in a couple years when it's complete? Is it the same ASHRAE standard that we're still using? There's a lot of these factors that go into this. So, next slide, Weston, please. Yeah, so a little bit about the ASHRAE path versus the EUI pathway. So as Weston mentioned earlier, as part of the Inflation Reduction Act, the IRS came out with they removed the interim lighting rule, which we used to use for lighting only, and they added this retrofit specific energy use intensity path. Now, that's great. The only issue is that the IRS has yet to issue guidance. And this is not an on the EUI path specifically. And this is not an uncommon situation with the IRS. And, they have the intent, the laws there, but they don't actually have the regs and guidance to tell you exactly how to accomplish certifying a project under the UI pathway. For the time being, just so you get an idea, I mean, we're using ASHRAE standard 90.1 from a requirement perspective as the baseline. And, to achieve 50% better from that ASHRAE baseline gets you the maximum 179D that's available. Projects before January 1st of 2015, they were looking at the ASHRAE standard 90.1 2007. Now, projects from end of 2014 or beginning of 2015, all the way through the end of 2026, those projects that get placed in service in that time frame have the ability to use the ASHRAE 90.1 2007 baseline. Now, from a modeling perspective, whether it be a retrofit scenario or a new construction scenario, that is a pretty easy standard to achieve and exceed when we energy modeling, because it's such an antiquated standard using that 2007 standard. Most energy codes around the country are at a much higher level from a code compliance perspective, and they're 2022 or better, type of situation. So anything that gets placed in service after December 31st of 26 bumps up to ASHRAE 2019. We still haven't run into that, right? We're not there yet, but our experience has been we've ran some test models, and depending on the property type and the use, classification of the building, it's like a 10 to 15%, difference. So it could reduce the deduction some, but again, technology and energy efficiency keeps increasing the stringency. So we expect that to level out as well as we move forward. And then anything after December 31st of 2028, they're moving up to ASHRAE 90.1 2022. Currently, we don't know if that's even going to be an option, because under the big beautiful bill, any projects that start after June, I'm sorry, of 2026 are no longer eligible for 179D. So that could be completely irrelevant if we don't see some sort of legislative change when it comes to that. Weston, next slide, and I think we're moving back to you here.
Yeah, thank you, David. Thank you. Appreciate it. Yeah, so kind of moving into the discussion around who actually is the designer of, an energy efficient commercial building, as it's a really key distinction when we're discussing the allocation of the Section 179D deduction for these tax-exempt projects. So projects on, state, municipal, federal level projects, anything religious institutions that are non, taxable or anything of that sort, they're still able to allocate a Section 179D deduction if all standards are met from an engineering perspective to the eligible contractors. But it's a really key important piece to understand who's actually eligible as a contractor because, there's been in the past some disagreement, both on a legal and legislative level. So it's important to really define this, right? So looking at the IRS's definition of the designer per 179D deduction rules, a designer is a person who creates the technical specifications for the installation of the energy efficient commercial property. A designer may include, for example, an architect, engineer, contractor, environmental consultant, or energy service provider who creates the technical specifications for a new building or in addition to an existing building that incorporates energy efficient commercial building property. A person who merely installs, repairs, or maintains the property is not a designer. So that's where it can get a little tricky, right? Because an installer isn't a designer, but in the past, there have certainly been some relatively publicized cases where an installer took a very large scale tax deduction for work which they did not do any of the design work on, and therefore aren't, by the IRS's guidelines, considered right a contributor to the energy efficiency of that project. So you can see a list under there that we provide some examples of who are designers. So everyone in these bullet points, those are considered designers of an EEC BP. And so that's a really key distinction as we discuss the allocation of the federal tax deduction here. Um,
And
and
just to
so,
just to clarify there, Weston, on
yeah,
the when we look at contractors specifically on that previous slide, um, the electrical HVAC or envelope contractors, those have to be design build agreements that they enter into. They can be eligible, but they must be in the capacity of a design build situation to qualify. So
gotcha. Appreciate it, David. So, discussing how the process of allocation actually works, the process of how the tax deduction is allocated can depend on kind of the specific entity you're working with, right? So, with a federal or state level entity, we've kind of drawn out here the process that typically occurs, which is there will be a request for a letter of intent to provide said allocation. Um, that'll include a project description document and a letter of intent form. That will then get signed, which is sort of, in a sense, a good effort to ensure that the work being done on the back end, the contractor can understand and feel safe that they are going to be allocated this deduction. Um, then you move forward with some of the other typical aspects of the Section 179D process, which is a site visit, obviously a significant amount of energy modeling and engineering, which both culminate ultimately in a certification, a final certification report, which is kind of the end all be all of what you would like to be able to feel confident in taking that deduction and having the correct documentation to do so. And then when working with these federal and state institutions, the received allocation letter that actually allows for the contractor, the designer, to take the deduction is provided to them. And then more of a typical pathway or a different pathway outside of working with those specific federal and state institutions would be the request for that allocation letter would come, and then you would receive a signed allocation letter as steps 1 and 2. Then the typical process would occur. A site visit would need to be scheduled and occur, engineering, and ultimately that culminating in that final report. David, anything to add there?
yeah, so a little bit talking. There's this is a general, statement. We could run into any, local municipality or any nonprofit or tax exempt that could have their own requirements. And one of the things that falls into we see quite a bit here is not quite a bit. We see less now, but we at one point, I've seen it quite a bit, especially with higher ed in the college campuses, is there's been a trend in that sector for these deductions to be requested to be shared amongst the tax exempt entity as well as the designer. So basically, you show up, you say, hey, I'd like to do 17ID on this project. We're the designer. We worked really, really hard on it, and we'd like to get an allocation letter for all of our efforts. If the university system or college system turns around, they may say, well, that's great, thank you so much, but in order for us to give you this allocation, we're going to want to share, and we want 50% of your net benefit when it comes to allocating, to the total tax deduction amount. So depending on the company, depending on your structure, there's good and bad things there. The good thing is, hey, they're willing to give you the allocation, and they do have a formalized process, and they're willing to pass that over to you. The bad is they probably think this deduction is worth, from a tax perspective or a cash value, a lot more than it actually is, right? Because somebody hears, hey, there's $1 million tax deduction on that. Well, what does that actually mean when it trickles down and it affects you? So depending on what type of entity you are, if you're a C Corp as a designer, that could be, a 35% tax bracket. $1 million turns into 350,000 of cash flow. That's pretty straightforward, right? And then you would go and share half of that with the net of cost, right? Net of the cost to certify and all that with this university system. But when you're a flow through, which most of the folks who are in business or an LLC or flow through of some sort, it creates quite a bit of the value kind of changes a little bit, right? Now you may be at an effective 28 or 30% tax bracket. So now $1 million turns into 3 million or 300,000. Furthermore, there's from a usability perspective, you may not have all the income to go and offset $1 million of deduction, depending on how big your company is. So now you're being requested to outlay cash by these tax exempt entities for that you may not use for 2 or 3 or 4 years as you carry those losses forward. And then one of the things that's highly overlooked by even a lot of the providers in this space is some of the firms who are peers to us and whatnot. It gets overlooked quite a bit, is the fact that it reduces your corporate basis. So, a good example of this is if you've been taking 179D for the last, I don't know, call it 10 years, and you've taken a total of $10 million in 179D. Now your basis in your company is $10 million less, which means that if next year big private equity comes knocking on your door and it's time to transact and cash out of your company, you're still going to benefit because you didn't pay ordinary income tax on that the 179D deductions that you took. But what's going to happen is you're going to essentially, on that $10 million you've taken in the last couple of years, because your basis is less in the company, you're going to have a larger capital gains tax of 10 million additional dollars that you'd otherwise wouldn't have to pay. So that's one of those effects that when people are sharing these things need to really be considered, and a lot of the commonplace of the request is about 50%. My recommendation is if you do want to play ball, right? And if you say, hey, there's value in us, nourishing this relationship with this tax exempt entity, we're willing to allocate it, we're willing to share the deduction with them. My recommendation is to not do much more than about 30% of the value, because that accounts for that risk. It accounts for the kind of clawback when you sell the company in maybe 10 years down the road, and it accounts a little bit for there is risk, right? There is real audit risk The 179D was part of the IRS's large business and practice unit watch list for audits from like 2017. It got put on there. So we do see quite a bit of audit activity. There's a lot that goes into making sure that there's compliance there. So that kind of guards against some of that risk. So sorry, Weston, I kind of hijacked your presentation here a little bit.
Yeah, all good, David. Really important details there. I think moving forward here, yeah, just discussing opportunity types, right? So now we've discussed the allocation process, what 179D is, kind of some of the key legislative changes, what actually defines an opportunity to take 179D. And really, relatively simple from what does qualify. Obviously, there's going to be a lot of things where you'd want to check with, professional and with whoever you're trusting with this process. But from a what does qualify perspective, any new construction, alterations or additions, retrofit or energy, service projects that are doing energy improvement capital, energy, improvements from a capital perspective, they're going to qualify, or at least, a pursuit of qualification should be initiated. But some areas where we see some folks kind of get a little confused would be something like a software only project, right? So a large institution, a campus, they do a large, infrastructure update to a lot of the tech, whether it's the IT or physical tech, etc. That is not something that's considered a the basis for a Section 179D tax deduction. Commissioning only activities. So we work with clients often that are in California, and a lot of them have a requirement to do commissioning activities every 5 years. Unfortunately, if it's commissioning only, it's not going to qualify for Section 179D. And then obviously any non-energy saving measures, right? This is obvious at the core of what we're talking about here is, energy savings. So anything that isn't related, that's obviously not going to qualify. Over to you, David.
Yeah. So yeah, I mean, to kind of touch on that, um, you know, the software only type scenario or the non-energy saving, we do run into a lot of projects where, they may have an energy project, but then they also do a refrigeration project, which saves energy, but just doesn't end up qualifying for the Section 179D because it doesn't fall under ASHRAE 90.1. It doesn't make sense from that perspective. So in that type of scenario, that wouldn't be a cost that's eligible or considered from a tax perspective, energy efficient commercial building tax property. So,
Thanks for the clarification, David. So just kind of discussing the roadmap to certification. We really kind of covered everything up until this point, and I think after this we'll kind of dive into some of the newer developments from a legislative perspective. But just to touch on this a bit, right? So what does it really look like if you have an interest here? You do a lot of work which you believe is going to qualify for Section 179D. How do you go about that? And so we kind of broke it down into a 6-step process. Every provider is going to have their own process. So this is ours. It's tried and true. We've been doing it 15 years. We believe this is, the correct approach, but, it's certainly not an industry standard, just ours. But typically you're going to obviously select an incentive partner. That's a step that really can't be, understated. It's really important how you go about that process. I mean, every business has different needs, different unique circumstances, different leadership approaches. And it's really important, obviously, to select a tax incentive partner that has, accreditation, that's been doing it a long time, that meets your needs. And sometimes I think folks overlook how the bottom of what we're doing, or actually the basis, really, it's engineering, right? We're energy engineers. David likes to say we're energy engineers, but we know enough about tax to be dangerous, right? I mean, this is really an important step. So it's always something I would encourage folks to take some time to actually do, which is, partnership selection. Then obviously moving forward, once you have your partner, you're going to go through and identify opportunities, right? So obviously dependent upon what circumstance you're in. Are you a CPA firm that has, various clients that we can help certify? Or is this direct to a commercial building developer? All of those are going to be different circumstances in terms of how we go about identifying and selecting opportunities. Once that process is complete, here at Walker Blue, we go through a complementary feasibility study. So we'll typically take some data. We will then go and take about a week to do some energy modeling and kind of understand from a feasibility perspective, right? Is this project going to qualify, right? And this is an important step here because some differing competitors may do this step a little differently than we do. But really, it's pretty simple. I mean, a project's either going to qualify or it's not, right? So we always like to do that at a complimentary, just free of cost. We will always give a prospective client or current client an understanding of, is this worth pursuing, right? And David touched on some of the complexities that go into that. It's not just does it meet standards, it's also what are your needs from a business perspective. So that all can kind of occur on step 3 there. And it really saves a lot of effort from both parties and obviously some dollars before running to enter an agreement. It's really important to identify, hey, there's really a tangible opportunity we'd like to pursue here. Obviously, once an agreement's put in place, more of that energy engineering modeling data collection will occur. We'll do initial models. We'll then go on site to ensure anything we're missing is collected, which is another really key step. Something that we do well here. Obviously, once all of that is completed, you have everything you need to create the final report, any additional modeling that may need to be done. And then that will produce a final certification report, which will allow you to actually obtain the deduction. So that's kind of the 6-step process. Anything to add there, David?
No, that's great. I mean, I guess the one thing to add would be that we do offer audit support. So at the end of this, if your project does get audited, we will offer audit support all the way through appeals. We'll work with your tax provider to make sure that any questions or whatnot gets answered. Not big thing we have to deal with often because, even though a lot of these projects do get audited, a lot of times just submitting our certification kind of satisfies the requirements to the IRS from what we're doing here. So.
Great. Awesome. Well, David, I think it's going to be over to you to discuss a little bit about the.
Yeah. So let's talk a little bit about the big beautiful bill. I know we only got about 5 minutes left here. 179D was made permanent in 2020, and it got expanded under the IRA with a 10-year window on the expansion in 2023. And here comes the Trump administration and the big beautiful bill. And apparently, permanent isn't actually permanent. It's permanent until they decide to make it not permanent. And we've run into some scenarios now where a lot of these energy tax incentives, 179D, Section 48, 48E, investment tax credits, are seeing differing sunsetting timelines as an effort by the administration to phase out these green energy incentives. It almost feels like it's a attack on anything Inflation Reduction Act. The 179D initially wasn't part of it when this came out of the Senate Finance Committee. It wasn't on there, and then it got added in the second round. So it was kind of interesting that they went down something that's been around since 2006, that they now are sunsetting it when it has such wide use. So I'll go through some of those dates here in the next slide. It is important to note that there is an executive order that was signed after the Big Beautiful Bill was signed that basically requires Treasury to create guidance on specifically what the end and beginning and end of placed in service looks like. So beginning of construction and placed in service. Historically speaking, we've operated under 2 methodologies. It's a physical work test, which is, hey, boots on the ground, work being done. And then the other one's a 5% safe harbor that kind of looks at the cost and says, hey, the relevant cost towards the energy incentive is about 5% there. So next slide, Weston. Yeah, so I'm not going to read through this. If you want, just skip on the next slide. That's just provided if you guys want to dig into the big beginning of construction, big beautiful bill. So kind of some of the key highlights here. If you're looking about the middle, Section 179D, it's available. The project starts before June 30th of 2026. Very, very important deadline there. So start of construction, boots on the ground. For now, 5% safe harbor could be an option. Not sure what that'll look like here in the next 10 to 15 days if Treasury actually meets the requirements of the President Trump's executive order and issues that or not. For Section 48 and 48E, specifically when we look at, solar and wind, there's some phase outs there that they're essentially available if construction starts before July 4th of 2026. Next slide, Weston. So yeah, some key things to note is that as far as the Section 48, Section 48E, the direct pay and transferability was remaining as part of the Big Beautiful Bill components. There is a requirement on projects over a megawatt to maintain prevailing wage and apprenticeship records and require those projects to also comply with that on a 5 and or 10-year window, depending on the type of project, on the maintenance and repairs in the future. The 45L tax credit for residential energy efficient homes, that's pretty much dead. Unfortunately, that's been kind of under attack since the IRA. And now they made it pretty difficult where you'd have to have the home leased or sold by July 1st of 2026 for and it also has to meet Energy Star Zero Energy Ready Home standards. So there's not much you can do if you're mid-project or you're on your way or you're planning to start a project. Odds are your multifamily project isn't going to be done by July 1st of 26 if you started today. It might be, but are you going to be able to lease it and sell the units? Probably not. A couple of other things with makers and there's some opportunities there. They changed around the way the depreciation works for Section 48, and then the advanced manufacturing tax credit. Still available for clean energy components. There is an exclusion for foreign-owned sourced entities, so FIAC is a concern, and wind components are getting phased out after 2027. So next slide. And then now, positive side is bonus depreciation got bumped up to 100%, which is good for the retrofit community, for qualified improvement property regs. Like a lighting project would fall under QIP, could get 100% bonus depreciation, as it falling under QIP. Now, unfortunately, the issue there is that it kind of hurts the 179D, because now you reduce the basis, you depreciated all of the asset, and you can no longer take the incentive. 179 expensing, the limits changed, and a big one, if anybody has been doing R&D tax credits in the past, they resumed full expensing of the Section 174 components, their amortized expenses, which previously were changed, and they're allowing for you to pull back the 2022 to 2024. So big expansion there on the R&D tax credits as well. So just a couple little things before we start Q&A. Couple of things we can also help with. Walker Blue specializes in ITC, so investment tax credit, anything solar, geothermal.
No worries, guys. I'll hop in here. As David was saying, we can obviously assist with a number of these services, including ITC. So any of those renewables, we do PWA compliance. So we help manage the prevailing wage and apprenticeship process to ensure you're going to obtain the multipliers as we discuss through this presentation. We obviously do, like I said, also offer traditional energy engineering services. So anything from decarb planning, investment grade audits, retro commissioning, etc. We also have a division that does a bit of state and local tax and property tax consulting. So just throwing that out there. Appreciate everyone's time. Thank you.
Perfect. Thank you so much, David and Weston. We do have a couple of questions. Some of them are quite long. So if in case, David and Weston, you want to see the questions while I read them, you can click on the chat button. The first one is by Carlos, and the question is, does testing, adjusting, and balancing fall into the apprenticeship labor requirements for the HVAC system?
Sorry, I had my mic off. So no, it would just be the installation of the HVAC systems. I would say you're pretty safe from the perspective of not including testing and balancing as part of having to meet the apprenticeship requirements as almost a separate activity.
Perfect. The next question is the best practice to have letter of intent signed by the township before any modeling for 179D begins? If so, how early in the project, how early in the project development phase should it be signed? We have been running into issues with getting them signed by some township while the 179D process has begun already. We are trying to see if we need to change this practice.
Yeah, so definitely my opinion is that the best practice is to get your allocation letter signed prior to signing a contract with us, unless they have a specific methodology or system in place that requires you to do the letter of intent at the beginning. My recommendation, rather than, on your kind of standard townships and whatnot, rather than going through and doing a letter of intent, my recommendation would be, be proactive on the front end of your contracts. Add language that the 179D belongs to you as the designer, because that will give you the most leverage to go request the allocation on the back end. You can point to your agreement and say, hey, as part of our agreement, section 10, bullet point 2 states that, any available 179D should be allocated to us. We included that in part of our proposal and our process. So yeah, that is something that I believe is it would be the best practice there, is to add language to your contract. Or, again, you could always start early, but a good time to get the 179D would allocation is at the closeout, like when you're doing all your final closeout on the project.
Thank you so much, David. The next question is by Victor, and the question is for existing buildings seeking deduction under 179D. Could you still use energy trend data rather than just 90.1 energy modeling? If so, would building control upgrade projects that save energy relative to trend data baseline qualify?
So for existing buildings, you could use energy trend data rather than 90.1 energy modeling. My only concern there would be that we don't have actual guidance yet from the IRS on exactly what that should look like. If there's kind of best practices and industry practices that could be used there, and say, hey, we need to beat 25% or better to achieve this. This tax deduction. So we're going to kind of use our standard practice and kind of, some of the Energy Star methodology and some of the other pathways that exist that use EUI as a method. In that scenario, my only problem with it is that currently we don't know if that's going to be the way the IRS wants you to do this. So, yeah, that's my opinion there.
Perfect. We have another question by Victor, and that was, could you confirm why you have listed on slide 14th geothermal phasing out in 2026 under section 48?
Yeah, that might have been.
Yeah, I was
that might have
gonna
been in there.
I was gonna take that one, David.
Okay.
That bullet was meant to be written as section 48 and 48E cover solar, wind, storage, geothermal. Not to say that everything under that was supposed to be phased out in July of 2026. That was poorly written, but yeah, that is it is correct in saying that it is not being phased out. It's just the way that was kind of poorly constructed.
Gotcha.
Thank you so much. The next question is by Tyson, and the question is, what is the interaction between 179D and 100% bonus depreciation? The 119 date for bonus depreciation is placed in service or started construction.
So that 119 date is placed in service after 119 for bonus depreciation. So 179D and bonus depreciation, it just depends on the type of project, right? If it's a new construction project, it's a moot point. You can take your bonus depreciation, you can take as much as you can, and you're still going to have plenty of basis in the asset that could take advantage of the 179D, and you can do both. You can take 100% bonus and 179D. So there is an opportunity there. Lighting retrofits is where it gets tricky. So in the case of a lighting retrofit specifically, you're going to, it doesn't make sense to do a 179D because you're going to be able to 100% bonus depreciate that lighting system. It falls under QIP, which QIP is eligible for 100% bonus, and that gives you the ability to write it off. So there's no sense in paying a firm like ours to certify this project when you have the ability to write it off and essentially get the same benefit, or the, maybe a larger benefit from doing 100% bonus versus taking a 179D. So.
Thank you so much. And the next question is, could you please highlight the type of projects that would be or would not be eligible for the expanded bonus depreciation? Essentially, what are the criteria to be eligible?
Yeah, I mean, I think I sort of answered that question in the previous response for the most part. I mean, I would think when we're looking at energy retrofits, like I said, lighting is a big one that would be eligible, but like HVAC wouldn't. So there's different scenarios there that would kind of qualify or not. Um, so that's pretty much it there.
Perfect. The next question is, since 179D is ending in 2026, where can companies potentially pivot having relied on these deductions for years?
Yeah, so I mean, look, that's where it currently is. My opinion is that, and the opinion of a lot of people in the industry is that the 179D is going to fall back into a tax extender cycle like it was from 2010 through 2020. It's going to be one of those scenarios where they kick the can on that phase out date. So right now it's June of 2026. I'm hearing from our lobbyist and whatnot that the goal is to go and push Congress to go and extend that date as part of a tax extender and maybe kick it down a year or two, make it 2027 or 2028 as start of construction. And that starts to really ramp up. So, I mean, even the 2026 date, a lot of times if a project begins prior to that, you're still going to be taking those deductions in maybe 2027 or 2028, possibly even 2029, depending on the size of the project. So, we're hopeful that we're going to see that shift go down the pathway for Section 179D, and we'll fall into that extenders rhythm and just add some instability to the process, unfortunately. But I think that's going to be where we end up right now.
Thank you, David. I do see one more question here, and that is, are the ITCs for green energy properties extending past 2026?
So the ITC for geothermal and battery storage is solar and wind are going to be phasing out after 2026.
Got it. And with that, okay, we do see another question that just came in, and it says, why would HVAC retrofit not be eligible for bonus depreciation?
It depends on the type of retrofit. There's going to be different scenarios. Honestly, we would have to. I specialize in energy incentives. I would have to get with my fixed asset group and kind of confirm exactly. But the way I've understood it, and it's my understanding is that the HVAC historically has not been eligible for QIP as part of the Tax Jobs and Cuts Act of, I think it was 2017 when they came out with the QIP projects. In those cases, that scenario would, that's my understanding as far as that they're not eligible. But I might be wrong. I've known to been wrong a time or two, so you never know.
Thanks again. And for the last question, we have, will IAQ projects qualify under 179D? We are the manufacturer and designer of our projects.
That's a loaded question. So yes and no. Just an IAQ project on its own for indoor air quality, will not. Now, if you go through the process of designing the project specifically to reduce outside air consumption based on, I forget the ASHRAE standard right now that allows you to do that. But if you go down that pathway and you design it as such, saying, hey, even contractually, I would recommend that the language be in there and say, this project is being designed using IAQ and using the ASHRAE protocol to reduce the outside air. That can be modeled, that can be accounted for on the other. And it's an activity that is qualifying from a tax perspective from the requirements of being an energy saving project. So again, just a straight, yeah, so ASHRAE 241. Thanks, Joseph. But yeah, I couldn't remember the exact standard, but yeah, that's the scenario there. So if you go down just doing an IAQ project because we're afraid of germs and COVID and whatnot, and it's not specific for the purpose of reducing outside air, then no. But if it is with that methodology in place, then it is an eligible activity.
Perfect. Thank you so much, David and Weston. This session was very informative. And that's a wrap for today's webinar. But before you log off, here's a quick question. Have you ever wondered why your energy bills are still high despite improvements? Join us on August 28th for Energy Audit Fundamentals and learn how to uncover hidden inefficiencies, get practical and expert-led insights. Learn more at mgmt.org. Again, thank you so much, David. Thank you so much, Weston and B3 Benchmarking and Walker Blue for sponsoring this webinar. Have a great day.
Thanks, everybody.